Hello everyone and welcome back to the sessions on Advanced Strategic Financial Management. Friends, within this subject, we have been discussing Advanced Capital Budgeting past few classes. In fact, more of little basic level questions I have attempted to cover in the earlier classes, just to give you a complete background support, a great foundation where you can actually begin learning advanced capital budgeting. So at your level, at final level, the topic advanced capital budgeting actually begins with this heading, that is decisions regarding replacement of assets. So let me tell you, decisions regarding replacement of assets, these can be classified into two different categories. One type could be deciding whether an existing asset should be replaced with a new asset or not. Whether replacement will be beneficial. If yes, you replace your existing asset with the new asset. If no, you continue with your existing asset. Now, over here, you need to deal with the cash flows of your existing assets if it continues to be used, and you need to find out what will be the cash flows that you will come across if you go for replacement. So that means you just compute two different set of cash flows. One, those cash flows that would arise in the future if replacement is not carried out, and those cash flows that would arise if the replacement is carried out. Then you can follow two different approaches. You find the present value of cash flows under both the situations and find which one gives you more advantage and take a decision. And in case life of both the decisions are exactly same, where annualization is not needed, then you can directly identify the incremental cash flow that would arise because of replacement. Then taking the net present value of those incremental cash flows would give you actually direct landing to NPV of the replacement decision. If that is positive, you go for replacement of asset, else continue with your existing old assets. Now, whatsoever I talk about this, it is not going to give you that clarity. What clarity you can obtain from a calculative example. So I have designed a wonderful example over here, and then a couple of questions that were asked in past exams. We are going to back to back solve those questions as well. But how you have to approach a particular question of replacement of assets, that idea you have to be very, very clear with. Your approach and your calculations both will require accuracy. So calculation accuracy, you understand. What is the approach accuracy? Read the question, understand what area it belongs to, and understanding how you are going to build up your solution, that is important. So what I'll do is, the very first question that I'll solve for you in this matter will be a question which I'll be approaching from two different viewpoints, or rather I would say I'll explain you by two different approaches. And in examination, the incremental approach should always be preferred because it will save your time. So I do not recommend the solution other way unless the question is designed where incremental approach cannot be used. That is why learning both the approaches, it is important. Then most times in exams when the questions have come, I would rather say not most times, all the times when the questions have come in past exams, they have always been based on incremental approach. Means question will give you license to use incremental approach, but we cannot go with that blind faith that question has to be designed that way. There may be a complication added in the question where the existing machines remaining life and the new machines total life are different. In that case, you will not be able to use incremental approach. So for example, a machine had been in use for past 10 years. another 6 years of its life remain. You can replace this machine with a new machine, but the life of the new machine may not be exactly 6 years, right? What if that life of the new machine is 10 years? So the point is, if you continue with your existing machine, it is another 6 years of lifespan remaining. If you install the new machine by replacement, the new machine will last for 10 years. Then both of your decisions have different time horizon and concept of annualization will have to be introduced. However, if I tell you that new machine also has exactly total life of 6 years only, then 6 years remaining life of existing machine and 6 years as total life of the new machine, both of these are going to give you possibility of using incremental approach. So let us do one thing. We will directly get started with some questions over here. Question number 10 to get started with. Let us read this question. So let us just read what is given over here. NJ Limited, a highly profitable company, has an existing machine with the remaining life of 8 years, having WDV of rupees 20 lakhs for tax purposes. At the end of 8 years from now, this machine is expected to have a realizable value of rupees 1 lakh. The depreciation rate as permissible under tax law is 25% per annum on WDV basis. Tax rate is 40% and the desired rate of return is 10% per annum. This existing machine, which can be sold for rupees 16 lakhs at present, is used to manufacture 55,000 units of a product which is currently sold at rupees 300 per unit. The unit variable costs are rupees 236 and annual fixed overheads excluding depreciation are rupees 10,40,000. To keep the existing machine in proper working condition, the company incurs annual repair and maintenance cost of rupees 5 lakhs over and above the fixed overheads. Further given in the question, the company is considering to install a new machine having life of 8 years. Now guys, when I read this line, what immediate outcome we should land up at? If I take you back to the previous part of the question, look at one thing. The existing machine has remaining life of 8 years, and the second aspect, the new machine has overall life of 8 years. Because the lives of old machine, whatever is remaining, and the entire life of new machine, they are matching with one another, it is an indication that you can use the incremental approach. Now, this new machine has a cost of rupees 60 lakhs. Residual value of the new machine at end of life shall be 9 lakhs. The installation of new machine will reduce the variable cost per unit by rupees 16 and annual repair and maintenance cost by rupees 4 lakhs. However, fixed overhead excluding depreciation will increase by rupees 60,000. You are required to advise NJ Limited regarding replacement of the existing machine with the new one. So how are we going to approach this particular question? So we first of all get started with some basic workings. We will first compute net initial outflow with an understanding that if the replacement is carried out, the new asset, the new machine would cost you 60 lakhs, and the existing machine, if you sell it right away, you will be getting 16 lakhs as recovery. From your pocket, the net initial outflow will be 44 lakhs. Now, after this, the most important working, before I in fact give you that working, I need to explain you something important. Don't just rush up writing this. Please keep patience. I need to explain you something important. Please keep patience. Listen to me. Now see what happens. Application of tax law in financial management decisions, it is very, very important. And what happens? How do you consider the tax implications? We have to understand that, particularly when it comes to replacement of assets. Now you see one thing, the WDV of existing machine was given as 20 lakhs. You can read the question and check. It is 20 lakhs, which is the WDV of existing machine. But this existing machine over here, we are mentioning that it is being sold for 16 lakhs if you go for replacement. So immediate thought that a student may get is 20 lakh worth of machine is disposed of for 16 lakhs. So there will be a short-term capital loss of 4 lakhs. It will be an error if you think like that. Why? Because in income tax law, we follow the concept of block of assets. And what you have done, it's not just your machine you have sold off and then done nothing. You have sold off your old machine and immediately acquired a new machine. So when you compute the block balance, the opening balance of block which is reported to you in the question, that was 20 lakhs. You have added a new machine costing rupees 60 lakhs, and then you have recovered from sale of existing machine rupees 16 lakhs. You know what will happen? Your revised balance of block will be 20 plus 60 minus 16. It will be what? 64 lakhs. You can check, it will be 64 lakhs. Now income tax law will permit you to charge depreciation on 64 lakhs if you go for replacement. So the point is, 4 lakhs of loss that you suffered by selling that old machine, that loss they will not consider as a capital loss because your machine balance of block did not become empty. The balance of that block now being 64 lakhs, you compare with the cost of the new machine, it is 60 lakhs. So you will not charge depreciation on 60 lakhs, which is actually the cost of the new machine, but you will charge the depreciation on the revised balance of block, that is 64 lakhs. One thing is very clear, income tax law goes with one straight logic. If you have spent from your pocket, any cost, if you cannot recover that cost, we will give you that benefit as a loss. Then you can charge off that loss and we will allow that loss. We will give you tax relief on that loss. That is how logically the tax law is structured. Now, your existing machine has a written down value of 20 lakhs. New machine that you are buying is having the cost of 60 lakhs. So total cost that you have incurred from your pocket at the present date is 20 plus 60, that is 80 lakhs. And out of that you have recovered only 16 lakhs from sale of the old machine. Your cost which is yet to be recovered, you can recover in two different ways, either by sale or by charging depreciation on that. Correct? When you charge depreciation, now you know one thing from accounting viewpoint, depreciation is just a book adjustment. Correct? It is a book entry where the cash outflow doesn't get involved. But what will happen in terms of tax? Because of depreciation charged at a higher amount, you will be allowed to charge that depreciation, the higher amount of that depreciation, and you will be accordingly getting the tax relief. So tax relief will be not on your loss that you have incurred on selling that old machine, but tax relief comes to your pocket by way of depreciation tax shield. So if there was no concept of block of asset, you would have charged depreciation on the cost of the new machine amounting to 60 lakhs, but because of this concept of block of asset, you will be charging depreciation not on 60 lakhs but on 64 lakhs. That is why the second working over here is very, very important. So please carefully take note of this second working note. Calculation of revised balance of block. So we start with the opening balance of block, that is 20 lakhs. Then cost of additions 60 lakhs, and subtract the sale value of the existing asset, that is 16 lakhs. The revised balance of block will be 64 lakhs. One more point I would want to clarify before you move ahead. How much is your initial cash outflow? Look into this. 44 lakhs, correct? That 44 lakhs, if you add to your opening balance of block, you will directly get the closing balance of block. Mathematically, 44 lakhs added to 20 lakhs would directly give you 64 lakhs. Either way, you compute you will be getting 64 lakhs as your balance of block. But in examination, when you are solving questions, please follow the presentation the way I have made over here. And now I would want you to write this quickly and then we move ahead. Alright friends, once you have completed writing these couple of workings, the next follow-up working will be with respect to computing depreciation. Now here we have to be very clear about two different situations. One is if replacement is not carried out, then you continue to charge depreciation at 25% on your existing block balance, which is 20 lakhs. If replacement is carried out, then your balance of block revises to 64 lakhs and you will be charging 25% on 64 lakhs. But because depreciation is on WDV basis, the block balance keeps reducing under both the cases, and you know how to apply WDV method of depreciation. I don't have to explain you that. This incremental depreciation, this column is the difference of the two depreciation figures that you will be getting in the first two columns, and this is designed mainly if at all you are solving question by incremental approach. Because this particular question we will be solving by both the approaches, you have to work out this incremental depreciation column as well. So placing the calculations of depreciation, which is very simple, year on year basis, you can keep charging depreciation. In the first column where we are writing the heading if replacement is not carried out, the base of depreciation from the first year was the block balance of 20 lakhs. And in the next column where replacement is carried out, you are taking the block balance revised to 64 lakhs for your depreciation computation. One more thing before you start writing this, we have taken the total of these depreciations. Why? Because by end of the life of the machine, you will be selling either of the machines, whichever you are using further, and you will be coming across some terminal cash flow. What was the WDV of the block of asset at that date? You need to know that very clearly. So before I take you any further, quickly write up this working note for depreciation. Alright friends, once you have completed this entire calculation, one calculation tactic that I generally discuss at intermediate level, I don't know whether you have learned those things at intermediate level or not, so I feel like sharing this with you, particularly when a question comes up with depreciation on WDV. For example, the cost of the machine, the new machine, okay, let's first talk about the existing machine. The WDV of the existing machine is given as 20 lakhs. Rate of depreciation is 25% on WDV. So 25% of 20 lakhs would give you what? 5 lakhs for the first year. You subtract 5 lakhs, you arrive at WDV of 15 lakhs. Second year depreciation base will be 15 lakhs, so on and so on and so on. But the shortcut approach of computing depreciations rapidly, each year depreciation is charged at 25%, so the remainder WDV will be at 75%. That means each year's depreciation will be 75% of the earlier year depreciation. Pick your calculator and take 0.75 as input in your calculator, 0.75, that is 1 minus the depreciation rate. Because depreciation rate is 25%, what I am inputting over here is 75%, 0.75. Multiply this to the first year depreciation, that is 5 lakhs. So first year depreciation, without using calculators you can calculate, it is 25% of 20 lakhs, that is 5 lakhs. So 0.75 into 5 lakhs, you press equal to, you get the second year depreciation. You press equal to, you get third year depreciation. Keep pressing equal to, you get all the years depreciation. Rapid calculation of depreciation using WDV method. Likewise, in the second column, which is talking about if replacement is carried out, your depreciation base was what? 64 lakhs as the revised balance of block. Again, without touching calculator, 25% of 64 lakhs will be 16 lakhs. Now follow the same approach. depreciation rate is 25%, so you pick 1 minus the depreciation rate, so that is 0.75 multiplied by first year depreciation 16 lakhs, press equal to, you get second year depreciation, press equal to, you keep getting depreciation for all the years. In fact, I'm sure you would have learned these techniques at intermediate level. Just in case you are not aware of such quick calculation, I thought of reminding this once. Anyway, once you have completed this, let us move ahead, and next working will be the terminal cash flow if replacement is not carried out. Now imagine if the replacement is not carried out, you continue with your old machine till end of life, then at that time its sale value will be 1 lakh. That is what reported in the question. But what will be its WDV? Today its WDV is 20 lakhs. Throughout its life, the cumulative depreciation that you are charging is 17,99,774. So the WDV is 2,226,000. Now after 8 years, that is at end of the machine's life, we don't know what is going to happen, because our calculation horizon is only next 8 years. Whatever be the difference, we will treat it as short-term capital loss, and on short-term capital loss there will be tax savings at 40%, and that works out to 40,090. So when you are computing your terminal cash flow, you are going to recover this scrap value, and there will be a tax saving of 40,090. So your terminal cash flow will be aggregate of these two components, that will be 1,40,090. So please write up this entire working, and then I take you ahead. Alright friends, once you have completed writing this working, we move ahead and carry out a similar working, but for the other possibility of the decision, that is if replacement is carried out. So we take sale value of asset at end of life. If you are using the new machine, after 8 years it can be sold for 9 lakhs, or you can say scrapped for 9 lakhs. But on that date, the WDV of that machine would be 6,40,723. And how we got that WDV? From the revised balance of block, you subtract the cumulative depreciation over next 8 years, and you get this as your WDV. Now you see that you are able to sell that new machine for 9 lakhs, whereas its WDV was only 6,40,723. So you get short-term capital gain over here, and you will be considering the tax outflow on this short-term capital gain at the rate of 40%. So your terminal cash flow will be this recovery of 9 lakhs minus the short-term capital gain tax that you might have to pay. Finding the terminal cash flow will be the net of these two amounts, that comes to rupees 7,96,289. So please write up this working as well, and then I take you ahead. Alright friends, so once you have completed writing this entire working, let us move ahead, and now we write a note. This note is not needed in exam, this is for your own understanding. After the above 5 working notes, the remaining solution can be carried out by separate NPV method, which generally we don't prefer, and the second is incremental approach, which definitely we are going to prefer. So just write this note for your own understanding quickly, and then I take you ahead. Alright friends, once you have written this note for your own reference, let us move ahead and we write the heading as a separate NPV method. Now let me just give you a quick reminder about why and under what situations this method will become a mandate for you. It will be mandatory for you to consider this method when a question informs you that yes, the existing life or the existing machine has remaining life of 8 years, but the new machine what you are trying to purchase, that has life of 15 years or life of 10 years, something other than 8 years. if that life of the new machine is something other than 8 years, you cannot follow incremental approach. Then you have to separately compute NPV of both. Then NPV will be annualized, and then you will look into which annualized benefit is higher, and accordingly you will take a decision. Annualization will be required in replacement decisions, but that will be at the later stage when we are dealing with the questions regarding timing of replacement. As of now, I would say you would just focus on one thing, that you are learning this possibility of separate NPV method just as a matter of safety. In case you ever get a question, you should be able to deal with it without any difficulty. So please continue writing the calculations under separate NPV method. The working note sequence will be working note 6, because 5 working notes we have already mentioned earlier. So we will now compute the profit before depreciation and tax if replacement is not carried out. So selling price per unit reported in the question is 300, variable cost per unit is 236, contribution per unit will be 64. Number of units that you are producing and selling currently, it is 55,000 units. Total contribution will be 35,20,000. Fixed operating cost other than depreciation, it is 10,40,000. Repairs and maintenance cost that you are incurring at the current level, it is 5 lakhs. So the profit before depreciation and tax will be 19,80,000. So please write up this entire calculation and then I take you ahead. Alright friends, once you have completed this entire working, let us move ahead and take up the next working, which will be calculation of profit before depreciation and tax if replacement is carried out. Now what will happen if you carry out the replacement? Selling price per unit remains same, but the variable cost per unit, you will find that it is getting reduced by 16 per unit. So the revised variable cost per unit will be 220. So contribution per unit rises to rupees 80. Number of units do not change, that will be 55,000. So the total contribution gets revised to 44 lakhs. Fixed operating cost is going to increase by 60,000, whereas repair and maintenance cost will be reduced by 4 lakhs. Earlier it was 5 lakhs, getting reduced by 4 lakhs. The repair and maintenance cost will be only rupees 1 lakh. Profit before depreciation and tax comes to 32 lakhs. So please write up this entire working and then I take you ahead. Alright friends, once you have completed this working as well, let us move ahead. And now, most important thing, present value of annual cash flows if replacement is not carried out. Mind it, we are talking about the present value of annual cash flows only. So here we are not including the terminal cash flow, because cash flows you will have to compute separately for each year. Each year's cash flow will be PBDT minus depreciation, you get PBT. Tax rate is 40%. So profit after tax will be 60% of profit before tax. And to the amounts of profit after tax, you add back depreciation to get the annual cash flows. Once you get the amounts of annual cash flows, thereafter you just apply the PV factors at 10% discounting rate, and when you multiply these PV factors to the amounts of annual cash flows, you will be getting the present value of annual cash flows, and that totals up to 68,82,633. So please write up this entire working and then I take you ahead. Alright friends, once you have completed this entire working, we will move ahead and make up one more similar working, but for the different scenario, that is if replacement is carried out. The format of presentation will be same, but the figures that you will adopt will be the figures as per this particular course of action, that is if replacement is carried out. Just be careful when you are handling a big question like this. You should not commit silly mistakes in calculations. Otherwise, it is just a little big question. It does not contain any complication as such. So once you plot all the cash flows, you write up the PV factors along with the PV of annual cash flows, and which is totaling to 1,19,86,227. So please write up this entire working and then I take you ahead. Alright friends, once you have completed writing this entire working, we now go with the main calculation required in the question, that will be NPV of replacement decision. But because it is separate NPV approach, we will compute NPV if replacement is not carried out, and then we will compute NPV if replacement is carried out. So if replacement is not carried out, the present value of annual cash flow that you get is 68,82,633, and the present value of terminal cash flow, mind it, this terminal cash flow we have computed in the earlier workings, and this is the 8th year PV factor, because terminal cash flow will arise at 8th year. Multiplying to 8th year PV factor, we get PV of terminal cash flow. Adding these two, we get the total PV of cash inflows. And you know what? If you are going ahead with your existing machine and not going for replacement, the PV of outflow will be simply 0. Then immediate outflow is not required if you are not opting for replacement. Therefore, NPV of replacement will be dependent on two different NPVs. One is if replacement is not carried out, and then the possibility that the replacement is carried out. But before I take you to that other working, first you write up this part quickly. Alright friends, once you have completed the calculation of NPV if replacement is not carried out, let us move ahead and compute NPV if replacement is carried out. In this case, the present value of annual cash flow is 1,19,86,227. The present value of terminal cash flow. This terminal cash flow we have already computed in the earlier working. 8th year PV factor multiplied to that, we get the PV of terminal cash flow. Taking aggregate of both the PVs, we get the total PV of inflows. From that we subtract the PV of outflow. Mind it, this outflow will arise only if replacement is carried out. So the very first working note in your solution indicated this amount of present value of outflow if the replacement is carried out. Now look at one thing, what will be the NPV if replacement is carried out? It is 79,57,701. Now what is the additional NPV arising due to replacement? It is the difference between the NPV of both the options, and that will be 10,09,716, which we can call as NPV of replacement decision. So this is the difference between the NPV of the two separate outcomes. So this is the NPV of replacement decision. That means this additional NPV will arise if you go for replacement of assets. So conclusion, existing machinery should be replaced because NPV of replacement decision is positive. So please write up this entire working and then I take you ahead. Alright friends, once you have completed this entire calculation and conclusion, let me explain you something important over here. See, the method that we have applied already is a separate NPV method. We determined NPV of the asset if the replacement is not carried out. We determined NPV of the asset if the replacement is carried out. The difference between the two NPVs was the NPV of replacement decision. The incremental NPV arising because of the replacement is positive, and therefore replacement will be the right choice. So we suggested that the company should carry out replacement. See, the other approach, which is a better approach, instead of computing present values of all the separate cash flows and then finding the difference, why can't we directly find the difference in the cash flows itself, which we can call as incremental cash flows arising because of replacement, and then we compute the present value of those incremental cash flows arising because of replacement. All inflows, outflows which are arising because of replacement on incremental basis, when you convert to their present values respectively, what you will land up will be the NPV of replacement decision directly. That is the incremental NPV. So, simple logic, you compute NPV of decision 1, NPV of decision 2, and then find the difference between the two. Or, how did you compute NPV, by the way? You have taken present value of all the cash flows from decision 1 and decision 2, correct? You do one thing, instead of converting the cash flows to their present values and then taking difference, you directly take the difference of cash flows and then convert into present value. Mathematically, you will land up at the same thing. For example, if I tell you that I give you either 500 rupees after 1 year or 800 rupees after 1 year, which one would you select? The obvious choice is 800, correct? Now, because you are finance students, you would say, okay, sir is giving 500 or 800 after 1 year. We will compare not these amounts of cash flows directly, but we find the present value of these cash flows. When you find the present value of 500, find the present value of 800, and then you compare the difference between the present values, you will get a certain amount of incremental NPV if you go for that 800 option. Instead, if you find 500 and 800 difference at the elementary stage, which is an incremental cash flow of 300, and then find the present value of that incremental cash flow, you will land up at the same calculation. Mathematically, it cannot make any difference. Of course, because the figures are big figures over here, there may be a rupee or so of rounding of difference that may arise, but that is all avoidable. You can just look into how would you go ahead with the second approach, that is incremental approach. So, you write the title incremental approach, and we again continue with the sixth working note. Mind it, because initial 5 working notes were common for both the approaches. In the sixth working note, we compute the calculation of incremental PBDT. Now see, right from here, your calculation starts becoming shorter. Savings in variable cost. Per unit, you are saving rupees 16. Total units that you are producing is 55,000. So the amount that you are saving in terms of variable cost, it is 8,80,000. Savings in repair and maintenance cost will be by 4 lakhs, and additional fixed operating cost you will be incurring from your pocket additionally every year because of the replacement decision. So incremental PBDT is 12,20,000. Look at one thing, you can check your earlier workings. When you computed PBDT, if replacement is not carried out, it was 19,80,000. PBDT, if replacement is carried out, was 32 lakhs. Difference between the two is 12,20,000. So please write up this working as well, and then I take you ahead. Alright friends, once you have completed this calculation, let us move ahead and continue with the next. Now we are computing the PV of incremental ACF. Please carefully look into the headings. Look at the headings particularly. It is all incremental PBDT, then incremental depreciation, then incremental PBT, then incremental PAT, incremental ACF. And every calculation that you are now finding is incremental, and the last two columns, be careful. In the second last column, you find the heading as PV factors, right? PV factors column, don't write incremental, and last column, be more careful. Don't write like all other column incremental as prefix. You don't write incremental PV of annual cash flow. No, it will be PV of incremental annual cash flows, because these are incremental annual cash flows you are computing the present values of these. So these should be the PV of incremental ACF. So make sure that all your calculations are plotted correct, and when you sum up, you get the PV of incremental annual cash flow directly. So please write up this calculation as well, and then I take you ahead. Alright friends, once you have completed writing this entire working, let us move ahead and continue with the next one. So now we are computing NPV of replacement decision. We take the PV of incremental annual cash flows. Then we must take PV of incremental terminal cash flow. So terminal cash flow, if replacement is carried out, 796 289. Terminal cash flow if replacement is not carried out, 1,40,090. Difference between these two terminal cash flows multiplied to the 8th year factor, we get this as the present value of incremental terminal cash flow. So when you add up these two, it is total PV of incremental inflows, and PV of incremental outflow will be 44 lakhs only and only if you go for replacement. So NPV of replacement decision is 10,09,716. Conclusion: the existing machinery should be replaced, and just because the NPV of replacement decision is positive. So please write up this whole thing, and that will be end of the solution. Alright friends, once you have completed writing this entire solution, let us move ahead and take up the next question, that will be question number 11. Let us read this question. HMR Limited is considering replacing a manually operated old machine with a fully automatic new machine. The old machine had been fully depreciated for tax purpose but has a book value of rupees 2,40,000 on 31st March 2021. The machine has begun causing problems with breakdowns, and it cannot fetch more than rupees 30,000 if sold in the market at present. It will have no realizable value after 10 years. The company has been offered rupees 1 lakh for the old machine as a trade-in on the new machine, which has a price before allowance for trade-in of rupees 4,50,000. The expected life of the new machine is 10 years with salvage value of rupees 35,000. Further, the company follows straight line depreciation method, but for tax purposes, written down value method depreciation at 7.5% is allowed, taking that is the only machine in the block of assets. Further informed in the question, given below are the expected sales and costs from both old and new machine. They have given you the data in the form of sales, material cost, labor cost, variable overhead, fixed overhead, depreciation, profit before tax, tax and profit after tax. Further informed in the question, from the above information, analyze whether the old machine should be replaced or not. If required rate of return is 10%, ignore capital gain tax. See, I have been telling you, the moment you come across this line, ignore capital gain tax, you are at an advantage over here, right? You don't have to make calculations of terminal cash flow separately. So the question seems to be very simple. After you have handled question number 33, this question doesn't seem causing any kind of difficulty at all. So let us look into how to present the solution over here. In your solution, we will first calculate the base for depreciation or cost of the new machine. Now notice one thing, the existing block contains only one asset and it is fully depreciated, means the opening balance of the block is 0. So we directly get started with the purchase price of the new machine and subtract the amount that you have recovered on sale of old machine, and that will give you the net balance of block, which is for the purpose of base for depreciation as 3,50,000. Next thing that we have to compute is profit before depreciation and tax. Now notice one thing, in the question they have informed you the profit as per the accounting records, that is profit before tax as per books. This profit is unacceptable because depreciation has been charged as per straight line method, right? So you add back the depreciation which is charged as per books. We will be getting the profit before depreciation and tax, and that we will consider for our calculations ahead. So before I take you further, please take note of these workings over here. Alright friends, once you have completed this much, let us move ahead and continue writing further. We will now compute the incremental NPV. So this will be based on all your incremental calculations only. So for all the years further, that is years 1 to 10, the incremental profit before depreciation and tax is 80,000. So mind it, we always prefer following the incremental approach. I have given you the detailed guidance in question 33 that why incremental approach is better. And then the depreciation base also what we have computed was as per the incremental approach. So we are computing depreciation at 7.5% on WDV basis. Now generally, if you can recall, we always take the aggregate of depreciation for the purpose of computing capital gain tax. Here they have asked you to ignore the same, and that is why we don't have a need to take the aggregate of depreciation. PBDT minus depreciation will give you profit before tax. Then there are no losses, so you just compute tax at the rate of 30%. So from profit before tax you will subtract tax and add back depreciation to arrive at cash inflows. I don't have to explain you this. Once you get cash inflows, you apply PV factors at 10%. PV factors were also reported in the question itself, so you don't have to struggle with this. And once you multiply the PV factors to the respective amount of cash inflows, you will be getting the PV of cash inflows. So this is all on the basis of incremental approach. So it is PV of incremental cash inflows. Please write up this entire working and then I take you ahead. Alright friends, once you have completed writing this entire calculation, let us move ahead, and now what we do is we take the PV of incremental cash inflows, we add PV of salvage value of the new machine. The new machine will have salvage value of 35,000 at end of 10th year. So 10th year PV factor we have multiplied over here, and when you take aggregate of these two, we get total PV of incremental cash inflows. From that you subtract the PV of incremental outflows, which is nothing but the net cost of the new machine, and finally what you get is incremental net present value if the asset is replaced. Because the incremental NPV is positive, you should go ahead with that. So you will say, since incremental NPV is positive, the old machine should be replaced. So please write up this whole thing, and that will be end of this solution. Alright friends, once you have completed writing this entire solution, let us move ahead and take up the next question. That will be question number 12. Let us read this question. Zavli Limited has a machine which has been in operation for 3 years. The machine has remaining estimated useful life of 5 years with no salvage value in the end. Its current market value is rupees 2 lakhs. The company is considering proposal to purchase a new model of machine to replace the existing machine. The relevant information is as follows. Cost of machine they have given, estimated life they have given. So for existing machine the estimated life is 8 years, of which 3 years have already passed, so the remaining life will be 5 years. On the other side, for the new machine the entire life itself is 5 years. So existing machine remaining life and total life of new machine, they are same, that is 5 years. Salvage value for the existing machine after end of its life, it will be nil, but for new machine it is given as 40,000. Output Here you will be able to produce more output if you are using the new machine. Selling price per unit has been given, annual operating hours have been given, material cost per unit given, labor cost per hour given, and indirect cash cost per annum given. So there are some changes in terms of cost and the outflow information. Anyway, we will be observing what is given further. The company uses written down value depreciation at 20% and it has several other machines in the block of assets. The income tax rate is 30% and Zavli Limited does not make any investment if it yields less than 12%. This line indicates that 12% is the cutoff rate. The company is not interested to make any investment below 12%. So 12% is cutoff rate. So we will be considering 12% as discounting rate, and they have given the PV factors for next 5 years already using the same discounting rate of 12%. Again, the solution for this question will be plain and simple, because again what you have learned in question number 33 is enough for you to handle a question like this. So let us look into how to present the solution. We compute the initial cash outflow. The cost of the new machine is 10 lakhs, and if you go for replacement, the sale value of the existing machine will be 2 lakhs at present. So your net initial investment will be 8 lakhs. Quickly take note of this working and then I take you ahead. Alright friends, once you have completed this entire working, let us move ahead, and now what we do is we are going to compute the base for depreciation. For this purpose we need the WDV of existing machine. The question doesn't inform you the WDV of existing machine, they just give you one thing, that is the cost of the existing machine. Now cost of existing machine was given as 3,30,000. You charge depreciation for year 1, then for year 2 and then for year 3 at 20% on WDV basis, and you find the WDV of existing machine. Now the depreciation base for the new machine will be WDV of existing machine compared with the cost of the new machine. You subtract the sales value of the existing machine, and the depreciation base for new machine what you get will be 968,960. Now the depreciation base for existing was 168,960, for the new one it is 968,960. The difference between these two will give you the base for incremental depreciation, that is 8 lakhs. Now what we have learned in question number 33, I will tell you one simple straight thing: whatever be the addition in the block, your depreciation advantage increases just by that. So your net addition to block was 8 lakhs. So it is clear that the incremental depreciation base will also be 8 lakhs. So if you are going by incremental approach, 8 lakh information is enough. You don't need the separate depreciation base for the existing and new machine. But if you are going for the separate NPV approach, then you will need both of these information. Anyway, you please write up this entire working and then I take you ahead. Alright friends, once you have completed writing this entire working, let us move ahead, and now what we do is we compute the annual profit before tax and depreciation, that is PBDT, for existing machine, new machine, and the differential values for the purpose of incremental approach. So annual output, sales revenue at the rate of 15 per unit, cost of operation, that is materials at the rate of 4 per unit, then labor for the existing it will be 3000 hours into 40, for the new it will be 3000 hours into 70, and then for indirect cost it is directly known amounts, 50,000 for existing, 65,000 for the new machine, and 15,000 in the incremental or differential column. So the total cost and sales revenue, when you take the net, you get profit before depreciation and tax, that is 1,60,000 for existing, 5,50,000 for the new, and 3,90,000 as the incremental PBDT. So please write up this entire working and then I take you ahead.